Hello, Facebook family and friends. This is Moss from Invest Partner Group. How are you today? Today, we are going to talk about why is sustainable property portfolio important. Let me take some time to explain to you what is a sustainable property portfolio. A sustainable property portfolio is something which is very well balanced and can withstand any property cycle. It is also very self-serving in nature, which basically means that it generates enough money on itself that it does not depend on the serviceability to survive, which basically means that you go on sleep, you go on holiday, God forbid you touch wood, you die, the portfolio keeps on growing like a working machine, okay? Now, it's important to have this portfolio in place such that in 6 to 7 years' time, that property portfolio would be able to withstand any property market shocks, which basically means that you would not have to sacrifice your lifestyle to maintain it. You can focus your energy and on things that matter to you most while the portfolio keeps working in the background. Okay, now how do we achieve this sustainable property portfolio? The important thing for a sustainable property portfolio is that it's made of mix of various foundational, expedition, and worthy properties. The FEW method, and let's take some time to understand what this FEW method means. Well, it provides a holistic growth, yield, and return to your property portfolio, which basically means that in order to have a sustainable property portfolio, you need to understand which property to add to your portfolio. I call it a FEW method. Well, FEW stands for foundational, expedition, and worthy properties. And what does that mean? So foundational properties. Foundational properties are entry-level properties. They are low risk, really strong growth, definitely positive cash flow, positively geared if possible. Capital requirements around $50,000 to almost $150,000, and a strong yield of 5% and over. Expedition portfolios or expedition properties. Expedition properties can only be added once you have really good foundational property portfolio set up. They are slightly higher risk, but they accelerate capital growth and cash flow requirements for you. They require additional value add to the properties, where you talk about renovation for profits, forcing equity on your properties, and majority of investors stay between this space of foundational properties and expedition properties. The capital requirement for some of these go from $150,000 all the way up to $400,000. Now, worthy properties is the classic example of generating significantly high passive income. These properties basically mean that they are slightly higher in risk, but really high in reward. Okay, there is a lot more to cover when it comes to worthy properties. These include things like rooming houses, commercial properties, multi-unit developments, micro apartments. There is a lot more complicated financing involved, and the capital requirements for these start from $300,000 and continue to go over. Now, how do we do this? We apply our wealth creation metrics and the FEW methodology together such that you can manage your property portfolio on a consistent basis, that you're catching growth and equity via investing in growth suburbs, and the banks would never say no to you. Now, they would never say no to you because you have strategically placed properties to take yourself out of the serviceability trap by forcing equity into development potential properties that you hold as a holistic nature of your portfolio. That is it from me. Thank you for listening to me. Let me know if this resonates with you. Feel free to drop in and comment, and reach out to me if you want to talk more about this. Thank you very much, and enjoy the rest of your day.